John Pierpont Morgan was born on April 17, 1837, in Hartford, Connecticut, into a family that already understood how money moved across national borders. His father, Junius Spencer Morgan, was a banker who built a strong network between the United States and Europe, particularly London, which at that time was the center of global finance. From an early age, Morgan grew up in an environment that discussed not only trade and industry, but also credit risk, currency stability, and the importance of reputation in the business world. He was not raised to seek popularity. He was shaped to understand the power that comes from control over capital. Morgan's education took place in America and Europe, giving him an international perspective that few American businessmen of his era possessed. He studied in Boston, then continued to Switzerland and Germany, absorbing European discipline in finance and organization. This cross-border experience made him understand that stability and trust are the main foundations of the financial system. When he returned to America in the mid-19th century, the country was on the verge of a major transformation. The Industrial Revolution accelerated the construction of railroads, steel factories, and telegraph networks. However, this growth was not accompanied by stable governance. Companies were established rapidly, often funded by speculation, and many collapsed due to uncontrolled debt. The American stock market was known to be wild, full of fluctuations, and vulnerable to panic. Morgan saw this disorder not as a threat, but as an opportunity to build a more structured system. He began his career at a banking firm affiliated with his father, Duncan Sherman and Company, before eventually building his own path through Drexel, Morgan and Company. It was here that he began to form his reputation as a decisive banker who was not hesitant to make major decisions.
Morgan understood that simply providing loans was not enough to create stability. If the companies being financed lacked discipline, the risk of failure remained high. Therefore, he developed an approach that later became known as Morganization. The concept was simple yet revolutionary. If a company was on the verge of collapse due to poor management and excessive debt, Morgan would not only inject capital, but also take control, replace management, restructure debt, and enforce operational efficiency. He merged smaller competing companies into larger entities that were more stable and capable of controlling market prices. This strategy was widely applied in the railroad industry, the most vital sector of the American economy at that time. Railroads were the backbone of industrial and trade expansion. However, many railroad companies went bankrupt due to overexpansion and corrupt practices. Morgan entered as both mediator and controller. He facilitated agreements between competing companies to avoid destructive price wars that harmed all parties. He enforced financial transparency and demanded management discipline. Investors who had previously been hesitant began to see Morgan's involvement as a signal of stability. Thus, his reputation grew as an architect of order in a chaotic system. Morgan's dominance in the railroad sector expanded his influence into other industries. He realized that true financial power was not only in the ability to lend, but in the ability to organize industrial consolidation. At the end of the 19th century, he began to be involved in the merger of electricity and steel companies. His collaboration with Thomas Edison in the formation of General Electric demonstrated how capital and innovation could unite to create a modern corporation. Morgan was not interested in the technical details of products. He focused on ownership structure and long-term stability. He saw industry as a network of assets that could be reorganized to maximize efficiency and market control.
One of the most monumental steps in his early career was the formation of United States Steel Corporation in 1901. By merging various steel companies, including those owned by Andrew Carnegie, Morgan created the first company in the world valued at more than $1 billion. This figure was extraordinary for its time, and marked the birth of the giant corporation era. This transaction was not merely a business event, but a symbol of the transformation of America's economic structure. Scale became the primary weapon. With large size, companies could control supply, prices, and access to markets. Morgan stood at the center of this transformation as the architect of the deal and guarantor of financial stability. His success in steel strengthened his image as the organizer of national industry. However, such power also brought criticism. Many began to question whether massive consolidation created monopolies that harmed competition. Morgan himself rarely spoke publicly to defend his position. He preferred to work behind the scenes, relying on reputation and elite banking networks to maintain his influence. For Morgan, market stability was more important than popularity. He believed that an organized system benefited all parties more than speculative chaos.
As the early 20th century approached, Morgan's influence extended beyond banking. He became a central figure in financing major projects, including the restructuring of insurance companies and government financing. He was known to have direct access to European banks, enabling international capital to flow into America on a large scale. These cross-continental relationships strengthened America's position as a rising industrial power. In many cases, the success of major projects depended on Morgan's approval and support. A childhood shaped in an elite financial environment, international education, strict discipline, and aggressive consolidation strategies formed the foundation of his early dominance. He did not build power through political office, but through networks of trust and control over liquidity. When industry needed rescue, Morgan arrived with conditions of control. When investors sought certainty, his name became a guarantee. At this stage, before the major crisis of 1907 and before the establishment of the Federal Reserve, Morgan had established himself as the most influential figure in the American financial system. This early dominance became the stepping stone for the next chapter in his history, when the personal power of a banker would be tested by national panic and determine the future direction of the American financial system. Entering the 20th century, John Pierpont Morgan's position was no longer merely that of a successful banker, but a figure standing at the center of America's financial architecture. His early dominance in the railroad and steel industries had shaped a new pattern of power. Large industries no longer stood alone, but were connected by networks of capital controlled by a handful of elite bankers. Morgan understood that in a modern system, control did not always mean full ownership, but the ability to influence decisions through financing, restructuring, and consolidation. It was here that his power further matured.
In the early 1900s, the American economy grew rapidly, yet remained fragile. Stock market speculation increased. Short-term loans were used to finance long-term investments, and the banking system was still fragmented without central oversight. Morgan viewed this instability as a real threat to the industrial structure he had built. He believed that stability was more important than unrestricted market freedom. In various closed-door meetings with bankers and major businessmen, he pushed for closer coordination among financial institutions to prevent destructive competition and price wars that harmed all parties. Morgan's relationship with the government also grew closer. Although he held no public office, his influence was felt in fiscal policy and national financing.
At the end of the 19th century, when America's gold reserves declined and threatened dollar stability, Morgan led a consortium of bankers to inject gold into the government treasury. This move saved the gold standard and strengthened international confidence in the American economy. The action confirmed that private financial power could have a direct impact on national policy. However, it also sparked criticism that too much power was concentrated in the hands of one individual. The year 1907 became the greatest test of the American financial system before the birth of a central bank. The panic began with failed speculation in the stock market and quickly spread to trust banks in New York. Customers panicked and withdrew their deposits. Liquidity dried up, and the risk of systemic collapse became real. Without the Federal Reserve, there was no official institution to act as lender of last resort. In this situation, Morgan returned to center stage. He summoned leaders of banks and major companies to his private library in Manhattan. The meetings lasted through the night, filled with pressure and tough negotiations. Morgan analyzed financial reports in detail, deciding which banks deserved to be saved and which should be allowed to fail. He coordinated collective capital injections to halt the wave of panic. These actions succeeded in stabilizing the market within days. However, the crisis of 1907 left a deep impression. A national system could no longer depend on a single private figure. Public and political pressure increased to establish an institution capable of managing crises systemically. A few years later, in 1913, the Federal Reserve was officially established. Ironically, Morgan died in the same year, as if closing the era of personal dominance and opening a new chapter of centralized oversight in the financial system. After his death, the firm he built, J.P. Morgan and Company, remained a major force. Leadership passed to the next generation and senior partners, yet the culture of discipline and prudence was maintained. The bank played a crucial role in financing the Allies during World War I, strengthening transatlantic relations and positioning America as the world's leading creditor in the post-war period. This role further solidified the bank's position in the global system.